Hi everybody, Marco Carbajo here from businesscreditblogger.com. Today's video we're going to talk about the fast bridge loan strategy for paydowns. This particular video is for those of you who are wanting to go through business credit card funding, or you got a projection but you couldn't proceed with business credit card funding because you have high credit card debt. We have a solution for you, and this video is going to talk about the bridge loan strategy. So this is a very powerful video. This is the first time we're talking about this particular strategy. And this will help those of you who are even thinking about going through business credit card funding but have not submitted your report for review because you have too much credit card debt. So let me share with you this particular strategy. What is a bridge loan exactly? It's an amount of money, it's a short-term amount of money that's lent to you by either a bank or a lender in order for you as an individual or as a business to secure financing. You may have heard of bridge loans mainly in real estate. It's a really common type of funding product for real estate investors. But for this particular video, we're talking about business credit card funding. We're talking about utilizing this particular strategy with our bridge loan lender to help you acquire business credit card funding. So this is also known as interim financing, gap financing, or swing loans. This basically bridges the gap during when there's times you need financing but it's not available to you yet. So this helps you achieve that. Now, both companies and individuals can use bridge loans, but for this video, we're talking about companies. We're talking about businesses, your business. Lenders can customize these types of loans, these bridge loans, for many different types of situations, like I talked about real estate or even credit card pay down. So our particular bridge loan lender lends anywhere from $5,000 to $20,000 in bridge loans for the purpose of paying down your credit card debt, so you could go through business credit card funding. So I'm going to share with you what it's called the bridge loan strategy and how it can help you if you fall under this particular situation when we do a review for you for business credit card funding. So I'm going to share with you an actual example, a client example, so you can see the bridge loan in action, how it works, and how it can benefit you. Okay, so let's first talk about, as you know, if you want to get business credit card funding, whether you're a startup or existing business, the first step is submitting a copy of your credit report. So this client ordered a credit report. You go to creditreportengine.com or triadcreditreport.com. It only costs you $1. It's not a hard pull on your credit because you're ordering your own credit report, and we don't charge you anything to do a pre-qualification review. It's free. You download your credit report, your full credit report, not your scores, and once you download your full credit report, you then upload it by going to step 3, businessfundingreview.com. That's our secure page where you can upload your credit report, put in your data. We do a review, 24, 48 hours. We come back what's called a funding projection. Okay, so now in this situation, this particular client did those 3 steps, and you could do the same steps to get a review. But this client, at the end of 48 hours, we had a funding projection for this particular client. They had $60,000 to $80,000 we projected in business credit card funding, with an additional $20,000 in loan funding, because this particular client wanted maximum funding, as much money as we can acquire for them, using the data they put in the form. So we projected a total of $80,000 to $100,000 in potential funding for this client. Now, this is the rating the client get. The only way we could take them through funding and acquire this $80,000 to $100,000 was if they addressed the credit issue that our underwriting department identified. They got a rating of C2A3. So what is C2A3? With underwriting, they have a rating system. Our particular underwriters use this particular rating. C2 means that there's a pay down required. A3 is the amount of funding that we're projecting. There's A1, A2, A3, A4, A5, and there's different C classes as well. This particular client got a C2, A3. If you get a C3 rating, that means you're completely denied. We can't project anything for you. So this client got a C2, A3. That basically means that we have a funding projection for you, but you have to do some pay downs. You have issues with your credit. So there were pay downs required for this client that had to be addressed before we can acquire this funding. So this particular client had a Chase credit card that had a 98% credit utilization. So there's too much debt on the credit card. So underwriters believe when you submit this to the banks for additional credit for the business, that's a problem. So to position this client perfectly present them to the banks, the recommendation for this client was to pay the balance to $9,000. Okay, so it was a $9,000 balance. They had to do a pay down. They also had a Discover card that had a 65% utilization. This is their personal cards they had. So the total pay down was about $14,000. So think about this. $14,000 had to be paid down in credit card debt in order for this client to get $80,000 to $100,000 in additional capital for the business. Okay, so now that's what happens many times when we do reviews. You may get a projection, but you have to do certain conditions. You have to pay down some credit card debt, or let's say you have to remove an authorized user, etc. So there's options here. This particular client knew exactly they had $80,000 to $100,000 in capital that they needed, but the thing holding them back was the $14K. So there's options. The first option is they had to pay down the credit card debt. They could use their own cash. Okay, so $14,000 is a lot of cash to put out. So if they had it, great. This particular client didn't want to use their cash. They didn't have all of it as well. Okay, so if you got a review and you had to pay down credit card debt, let's say you don't have the $3,000 or $4,000 you had to do a pay down, or $5,000 or whatever number it is. Let's say you have the cash, great. Make the pay downs and move forward with funding. The problem though is, what if you don't have the cash? You have a great projection and you need the funding for your business, or you need it for real estate investments, or etc., but you don't have the cash to make the pay downs to qualify for funding. Okay, so that's the problem. What if you don't have enough cash for the pay down? What if you only have a portion of it, but it's not enough to make the required pay down to get funded? Number three, what if you want to conserve your cash? Let's say you have a real estate deal that you want to do, and you have cash in the bank, and a portion of that's going to be used for your real estate deal, so you can't use it, but you also need the additional funding to make the deal happen. Or let's say you just don't want to use your cash because you like to be liquid, but you do need the additional capital for, let's say, to purchase inventory, or you need to scale your business, or you want to purchase a business. So there's many reasons why you want to conserve your cash, obviously. Now, creatively, most people think, well, why can't I just balance transfer? Why wouldn't you balance transfer this $14K to another credit card, or spread it out? The problem with that, and the reason why that doesn't work in the scenario, is because the overall credit utilization will still remain the same. You're just moving debt around. This particular client what if you might be thinking, well, why don't they just get a couple more credit cards and then transfer the balance? They have more credit available. The problem is, if this client got more credit cards, that's more inquiries, more new accounts, which impacts our projection. Our projection is strictly based on paying it down with no new inquiries, no new accounts, or anything, or not even moving the balances around. They had to do a straight pay down. Okay, so this is option number one, is pay it down with your own cash. Option number two is using other people's money to do the pay down. That's the other, and many of you know that strategy, OPM, other people's money. It's leveraging the use of other people's money. So that's where the bridge loan lender comes in. Okay, so how does this whole scenario play out? In this particular example, this client had a projection of $80,000 to $100,000, and they had $14,000 they had to pay down first before we can acquire the $80,000 to $100,000 in funding. So when the customer says, yes, I want to do this pay down, I want the bridge loan lender to take care of it. So what we do is we send the pre-qual document that to the bridge loan lender, and they see the pay down instruction that we provide to them. Bridge loan lender contacts the client, which would be you in this case if you're going through this program, and then they pay down the credit card debt in 48 hours. So the $14K wiped down on the credit cards. And then also what's unique about this bridge loan lender is they also provide a rapid rescore, so that would allow the credit reports to update immediately. There's an additional service for that. I don't recommend it, because basically what happens is you send at that point we start the business credit card funding process when we're notified from the bridge loan lender that the cards are paid down. Then what happens is we monitor the report. We have to wait for those pay downs to update on the credit report. So that be a little bit of time delay there. Once the updates hit the reports, of course, then we submit the apps to the banks that we've identified in the bank list. And the funding process is complete in 14, 20 days. The client receives funding, and the bridge loans are paid back. etc. So this is how this process works. So there's a lot of benefits to using a bridge loan. It has to make sense. The benefits of bridge loans is that it makes the pay downs required so you can get the funding you need. Okay, so if you're in a position where you get a review, we take you through pre-qual and we give you a nice projection on you need the funding for a specific need or an investment, you're going to get a good return, but you don't have the cash to make the pay down, then this will give you the opportunity to get that capital without using your own cash if you don't have it. So that's a benefit for the bridge loan. The other thing is it allows you to conserve cash. So if you don't want to use your own cash to do a pay down, if it's required, this is an alternative option for you. And that's all I'm sharing with you here is an option. It's a strategy. It doesn't work for everybody, but it's a strategy and it's an alternative for those of you who need to get business credit card funding, but yet you have too high of credit card debt holding you back. So you get to use other people's money rather than your own. You get the return on investment you project. So let me kind of walk you through why this is important and why a bridge loan would make sense in this particular scenario. So let's say you have, I like to use real estate because we get a lot of real estate investors who are needing cash for properties. But let's just say you need X amount of cash to pull out from business credit cards to do an investment deal for a real estate project, a fix and flip deal, and you have your own cash or you need to raise cash and you got a good projection, but it's requiring, let's say, a $7,000 pay down, let's just say, and you don't have the $7,000 or you don't want to use the $7,000. The beauty of this, but let's say the property you want to do, you're going to get a 40% return on the investment if you do that deal. That's just typically the returns. I know there's higher, some lower, but average is 40% return on investment with a fix and flips. So you see your good return that you're going to get, but the thing holding you back is you need just an additional capital to do the deal. Okay, so that's where using a bridge loan so you can get that capital makes sense because you know you're going to get a great return if you do this deal. Same thing happens in business. If we scale our business with this, using this particular, let's say, marketing campaign, or let's say we have to get this inventory to fulfill all these orders, it just has to make sense for you. You have to be able to put the money to work where you're going to get a return. Okay? But the beauty of it is if you do a bridge loan, remember, it's just a bridge loan to get you the funding, business credit card funding. If you do it, the beauty of this is that it's not a one-time deal as far as once you get the business credit card funding, it's revolving money. So for real estate perspective, let's say that additional capital allow you to do a fix and flip, but guess what? Because of that revolving money, you can do another one and another one and another one. So this is ongoing returns from an initial investment. And what I mean by investment is, of course, there's a bridge loan lender is going to have a one-time fee. We have a fee when we get you funding, but it's all on the back end. Nothing's up front. So there's no risk to you at all. You only pay the bridge loan lender once you get funded from us. So that's the beauty of it. Now, for business credit card funding, what do you actually need to go through business credit card funding? The separate legal entity, just going to run through this real quick. Your company has to be in good standing. You could be a startup or existing business. You need your EIN number, and make sure you have your EIN letter because that's a document the banks want to see. Your business contact information, business bank account needs to be set up. A quick overview on the business credit card funding program. You get 4 to 5 cards issued in the company's name. You're basically co-signing for the business. They don't report to your personal credit as far as the accounts. They only report to the business credit agencies. So this helps you build your business credit. We project anywhere from 25 to 100,000 in combined credit limits, but we provide you that projection. Our projections are about 95% accurate, so we're really spot on. We are conservative with our projections because our method is we like to under-promise and over-deliver. So now, as far as interest rates, depending on the bank, what they want to issue you, typically we work to get you 1 or 2 cards with 0% intro APRs on purchases. Annual rates range from 9 to 19.9%, but what we're seeing right now is anywhere from 9.9 to 15% annual interest rates on the business cards. You have your minimum monthly payments. Like I said, only reports to business credit agencies. This is going to create 4 to 5 positive trade lines reporting on your business credit report. So this will generate a credit rating for your business if it doesn't have one. You're going to have revolving credit reporting on your business credit reports, which strengthens your report. So this will position your business to get additional credit limit increases if you use your accounts responsibly, if the bank wants to issue you that. But more importantly, the long-term strategy is that you as a business owner now have 4 to 5 new relationships with banks. Those banks will see your history. You have a credit card with them for the business, but the banks also have additional products. They have additional cards. They have additional maybe loans or lines of credit. It's much easier to get credit and funding from an existing lender or bank that you have a relationship with compared to one that you have no relationship with. That's the beauty of why we want you to diversify and continuously build ongoing relationships across the board with vendors, suppliers, retailers, card issuers, banks, credit unions, etc. Okay, now for those of you who want to go through funding qualification, this is just a quick rundown. Again, it's a recap of what we went over earlier. You got to order your personal credit report, number one, upload it. We do a review 24 to 48 hours. Now, and remember, in the review, the results, if you get an 83 projection with funding projection with no paydowns required, that's great. You don't even need the bridge loan strategy. We just move forward with funding for you. And it happens many times. But a large majority of reviews we do always typically require a credit card paydown because many people are overutilized on their credit cards. And our goal when we give you a paydown is to position you so you get the highest credit approvals, the best rates, the best offers from the business credit card issuers that we place you with. That's the goal. Anybody can give you a funding projection, but the goal is to get an accurate projection, a realistic one. And that's what we pride ourselves on when we're doing funding for our clients. Okay, so additionally, as you go through business credit card funding, we have additional products that we offer. Our business credit building system, they'll give you access to other types of credit like vendors, suppliers, retailers, fleet cards, etc. So that's a step-by-step system where you do it yourself. Be sure to check that out at businesscreditbuilders.org. That's our main website where we list all the types of funding products and our business credit building system. So with this video, give us a thumbs up if you enjoyed this information, and then click subscribe. That way you're getting notified on additional videos. We're always coming out with tactics on how to build your business credit, protect your personal, maximize your funding potential, whether you're a startup, existing business, or real estate investor. Make it a great day. We'll talk to you real soon.